Okay, welcome everyone. I'm Don Rissmiller. In addition to doing economic research at Strategas, I also have the distinction of being the chair of the Global Interdependence Center for this year. So we're very happy to be here at the bank in Chicago. I'd like to thank our host for a wonderful space. We have some topics to talk about today, but let me tell you a little about GIC first. So the goal of the Global Interdependence Center is to be a neutral convener of dialogue. So there's no advocacy of a particular position, but rather it's meant to bring together a group for discussion, for education, and then let everyone take something away and draw a conclusion on their own. So it got started back in 1976 in Philadelphia. So at that time, there was a big celebration of American independence that was going on. And that was nice, but a group of forward-thinking individuals decided independence was one thing, but the globe was becoming more interdependent as well, and that's where the interdependence part of the name comes from. And so over the years, a variety of financial institutions and banks and educational institutions have become involved, and we are where we are today because of all the speakers here, all the people who have contributed. And so we're looking forward to another good event today. There is a brochure in your packet if you want to see some of the upcoming programs. We have one on higher education. That'll be in Philadelphia on October 9th. We do go abroad. We're going to go to Madrid on November 15th and 16th, and that will have a speech by Raphael Bostic. We'll go back to Philadelphia at the end of the year for a global economic and policy outlook. And then early next year, we are organizing a small delegation to Cuba. This will be done through some of the travel agencies, and the goal there is to learn and really see what's happened in a place many people have not been for quite some time. So interdependence.org is a place you can go if you'd like to learn more about GIC, about any of these programs. You can also see Jill Fornito or myself, who can tell you more about the program. So let's talk about today. So in this venue with many distinguished guests, there's lots we could talk about. There are many concerns. We've had currency moves around the world, US dollar strength. We have the yield curve that's flattening. There's concerns in the financial industry about peak earnings growth, what that could mean. We have a midterm election coming up. We've had oil prices move higher recently. We've had issues with North Korea and geopolitics. There's talk of another debt ceiling fight coming in the US next year. We're seeing anonymous op-eds in newspapers talk about our political structure. But the goal today is to focus on one piece of this and talk about trade and the future of industry. So trade war became a phrase pretty quickly. We've elevated this in our lexicon to something that deserves that term. It's not that we never do tariffs. We've done this in the past in multiple administrations. The Obama administration put tariffs on some goods from China. The Bush administration in 2002 had a steel tariff. So we have done this, but this seems different. And I think that's partly what we'd like to explore today. Why does this time seem different? Maybe it's because we're fighting a three-front trade war, if you think about NAFTA and Europe and China. But that's what we'd like to dig into today. So for our first panel, which is the macro outlook, asking the question, are the risks symmetric? Let me turn the microphone over to Sangeetha Ramaswamy to take us forward.
Thanks, Don. Welcome everyone to the conference today. We have a pretty distinguished panel as our first panel on the macroeconomic outlook, and the panelists have all agreed to present for about 15 minutes each. I'll ask a few questions to get the discussion started, and then we can open it up to the audience as well. I'll briefly introduce our panelists. First, we have Catherine Mann, who has a distinguished career in public service as well as the private sector and now. She's the Global Chief Economist for Citigroup. Our second panelist is Michael Drury, Chief Economist of McVeigh Trading and Investments and former chair of GIC. Our third panelist is Philip Levy, Senior Fellow at the Chicago Council on Global Affairs, and we're very delighted to have him here as well. So we're going to just kick it off with presentations first, and then just go to the Q&A. Thanks.
All right, thank you very much. We had that little discussion right there. It seems like a little bit more conversational to sit here at the table rather than go to the podium, and so that's what we're going to do. I'm going to talk a little bit about this title as we have it here, Uncertainties Cloud the Global Outlook, and will these storm squalls pass through, or do we have something like Hurricane Florence to worry about? It's a longer presentation. As you know, in the private sector, things have to go through legal and compliance before they can be given out. So this is a presentation that has aged a bit in the last month, I think it's fair to say. But what I will do is go through it with you and put out some key points that I think are important when addressing this relationship between the macroeconomic outlook in a global context and firm-level decision-making with regard to business investment. Because the key ingredients that I'll be talking about is the interrelationship between financial market turbulence and the foundations from that, how that is generated by some of our macroeconomic issues as well as trade issues, and how either of those or both of those feed into the decision by firms to either continue on with the business investment strategy that they have in place, or to pause their investment strategy based on the degree of uncertainty. So the real question is, coming out of this, is there is a lot of macroeconomic stress, there is a lot of tariff concerns, and probably those are going to be realized. The collection of those two add up to some financial market turbulence on the horizon. And whether or not there is a lot of feedback to business investment or not is the key question for whether the U.S. economy and the global economy will continue to be strengthening into 2019, or whether they won't. So we're really looking at two different scenarios where the key factor is business investment. So let's start with, why is business investment so crucial? So the real issue here is that the green portion of the chart here on the left is how important the investment climate and the investment strategy of firms has been in the advanced countries in general for this current wave of growth in the advanced economies and percolating through global value chains to the emerging markets as well. It's actually rather odd to have so much investment or such share of investment being so important so late in a business cycle. Part of this, of course, is the delay in finding at the beginning of the year, having us at a synchronized global upturn. But there were other reasons for why you have strength in business investment so late in the cycle. And for that, I turn to two issues that will continue to be important drivers of business investment, both in the U.S. and more generally in other countries. These two positive foundations are, first, on the left-hand side, the age of the capital stock, and I'll go through that in a minute, and on the right-hand side, the challenge of tight labor markets. So these are in place now and will continue to be in place even if there is some deterioration in the current climate. So the left-hand side is investment as a share of the capital stock, and all of the arrows point to the left. The two different colors are indicative of the extent to which business investment did not, in the post-financial crisis periods, 2007 to 17, and then there's a forecast in there as well, to 19, the extent to which business investment did not make up for depreciation, but also the extent to which business investment in general was quite weak. And this is true across the advanced economies. The U.S. in the top is actually somewhat better than some of the other ones, but still is indicative of very old capital stock. Now, you can get a lot of details about the United States capital stock, the age by different categories of industry, by different categories of ownership, and by different categories of capital. So this is obviously an aggregate of all that, but just to give you a flavor for where we are in terms of the age of the capital stock, the U.S. capital stock is the same age as it was at the end of World War II. It's a different capital, of course, but it's the same average years old, which is 34 years. So the capital that U.S. industry is working with, and obviously it's true for these other countries as well, is old. It means that you've got an opportunity now to be more robust. If you have a robust climate for growth, you have cheap financing, it's a good time to add to your capital stock, to refresh your capital stock. If you're a small firm, you've got pretty cheap financing, you've got your tax windfall in the United States, you've got the 5-year horizon for 100% write-off of your capital. If you're a big firm, maybe you're a little bit more worried about the global climate, but if you're a little firm, I'm sure many of you read the NFIB study that came out yesterday. If you're a little firm, this is the best your life has been in decades. So you're going to invest if you have any sense of the age of your capital stock. And also, if we look on the right-hand side, which your survey measures of how tight labor markets is, if you're a small firm, you're probably not picking off the top of the barrel when it comes to labor markets. And so a second reason for refreshing your capital stock is to use technology to both complement and to substitute for labor. So there are a number of factors that are still positive foundations for business investment. They are particularly strong for I call them the NFIB Russell 2000 types. But the question is, are these strong signals going to be buffeted by the other concerns that are going on in the marketplace? So will these positive foundations for strong investment be buffeted by trade tensions, by financial market turbulence, by increasing diversity in terms of global growth rates? So will these positive foundations be undermined in terms of business investment? This is a picture from the August 7th Atlanta Fed note of a survey that was open in mid-July. And you can see across different categories, most firms are not reassessing their plans. 80% of all firms are not reassessing their plans. 20% of them are. So that's definitely more than half full. So that firms in the U.S. right now are not postponing their plans to a large degree. They are continuing to engage in their capital spending plans. It is worthwhile to note, however, for manufacturers there, it's the second set of bars from the right. If we think of those as being in the crosshairs, both with regard to exports of capital goods, as well as being as I say, in the crosshairs for trade tensions, they have a higher share of their plans, 30%, that they are reassessing. So some indication of concerns with business investment, but not yet across the board. So let's talk now about the uncertainties that are faced by business. And I'm going to make a distinction between, as I say, businesses that are I classify them as NFIB Russell 2000, best it's been in years. I don't engage with Wall Street very much. Yeah, I'm part of a global value chain, but I probably don't think about that much. My neighborhood is great. Distinguishing between those types of firms and the S&P 500, deeply engaged in the global economy, deeply engaged in Wall Street via stock buybacks, M&A, and issuing their own financial securities. So between these two groups, and again, the business investment strategic decisions, how do these types of uncertainties stack up? Well, the first one is about global growth, and it's desynchronization of global growth. The left-hand panel shows the extent to which data came in differently than expected in the beginning part of this year, going from a period of global synchronization, which was good for everybody, both the S&Ps and the Russells, and now much more diversity in terms of the growth rates. Things have come off the bottom for Europe, which is in the blue and the green, but still in negative territory. If anything, this desynchronization in global growth rates is going to get worse. And the reason why is China has slowed a lot more than most people thought it was going to. I'm just going to direct your attention to the left-hand panel, which shows the deceleration, there's no negatives there, but deceleration in growth rate for both fixed investment and for retail sales. Now, everybody expected China's growth to decelerate with regard to fixed investment. That was believed, that was kind of a expected and desired outcome of the financial market cleanup. What was not fully appreciated was that the consumption was going to be a large collateral damage from having a cleaned up financial sector with less credit growth and declining rates of growth of investment. When we think about it, we shouldn't be surprised because wealth, the consumption function, there's income, there's wealth, and consumer wealth was being hit by stock market collapse, essentially, and also undermined by the change in trajectory for real estate prices. So hits on consumer wealth, making them take stock of whether or not they want to do a lot of consuming. The second one, of course, is on the income side, and both SOE consolidation and the impact of credit growth reductions on employment in small businesses affect consumption streams through the income effect. These are not going to go away. The concerns about income are not going to go away. If anything, they are going to be accentuated by the tariff warfare, and that will be true for the wealth effect as well. So if anything, our prospects for China's growth are more of a concern now, a month later, than they were even in the middle of summer. So desynchronization, doubling down on that with the U.S. strengthening even more, and the global economy, particularly in Asia, doing worse. So let's talk now about the trade issues, and I direct your attention to the top panels. Normally we look at trade volumes, or it's common to look at trade volumes in terms of year-over-year growth rates, and that is the top left. And indeed, trade has slowed down, but we're not in the kind of picture yet that we were in 2015 and 16, which there's been some discussion, including by me, I would admit. Are we headed for a 15-16 kind of trade slowdown, which of course was very damaging to the global economy overall. That said, if you look at a higher frequency description of the data, which is in the top right, you can see there has been a deceleration earlier on in the year, and a more rapid deceleration earlier on in the year that kind of makes us look a little bit more worried. We're looking at more data as it comes in to see whether or not that bottom out that you see there represents a turn upward or whether it's going to be a flattening. So trade volumes and the deterioration of that already a concern. Now, additionally, I'm going to just skip back here. Additionally, we have the potential impact of trade on the global value chain. So we've described this using this exercise that you see here, which is what happens if China slows just because of the reasons that I said before. Not trade, but just because of the slowing of investment, slowing of consumption, and the collateral damage of consumption. But policies put into place to try to rectify things. So that's a black line. So China growth slowing kind of, organically, internally to its own policies takes about 50 basis points off of non-China global growth. That's kind of a big number against a global growth rate in 2019 of 3.4%. But the LKQ exercise that you see here, which is in red, is much more focused on an industrial slowdown that is precipitated and augmented by this tariff warfare, and that you can see how much that percolates through the global value chain in the neighborhood to make things way worse for the global economy. Now, there are some potential, this chart, we'll leave it, let me just actually go back to this one. This is an aggregate picture, of course, and the numbers have some range of, standard deviations around, as you can see. But the issue that is relevant here is if you're an emerging market investor, for example, we have done research to look at the extent to which the global value chain and the damage to the global value chain has both winners and losers. It's net damaging, but within that there are some winners and losers. Some countries that are hit through the global value chain can become direct suppliers. So they lose as a member of the value chain, but they gain it back because they become direct suppliers. So the buyers go around the China relationship and directly to the producer. So there are some trade diversion aspects that could be beneficial for some emerging markets. That very complex chart, which I did not stay on, but if you want to have that information, we can talk about it. So I want to move now I'm going to talk about inflation in another context. I want to talk now about financial market turbulence, because this is really a very key ingredient to our question about whether or not business investment is going to be net slower or resilient in the face of what's going on in the economy. There are a lot of different panels on this sheet, but they all talk about internally consistent asset pricing. They're internally consistent. Credit risk premia, equity risk premia, the relationship between VIX and high yield, U.S. Treasuries being low. These are all internally consistent asset prices. But they are not consistent with the march towards exiting from quantitative easing. The exit from quantitative easing, by the time it is complete, will be associated with a higher risk premium on credit risk, one that would be appropriate given the very high share of high yield instruments that are being issued. So you can see the credit risk premium and how low it is against the high share of high yield bonds, meaning low quality bonds, low credit quality, and that's in the upper left. What about equity risk premium? Everybody thinks, plenty more to go there. Well, but no. If you look at the bottom panel, the table, if you take the current earnings, standard equity risk premium model, and you use as your discount factor the current 10-year yield, you still have a nice cushion in the equity risk premium. That's the first underlined set of numbers there. If it's for a range of countries, the U.S. is the second from the left. But if you use a 10-year yield that has closer to the historical average, 1990 to 2007 being the average, you can see there's no equity risk premium at all. So that says the equity markets could easily be primed for some correction. You can also look at this question about whether or not the 10-year yield should be above or below 3. 3 is just a magic number. It's the one that is a reference point point in the financial markets. It's very close to 3 right now. I think it's maybe 3 basis points below. I haven't looked at the market today. But there are a number of issues on financial market positioning, and you see the information for the shorts there in the light blue line in the lower right-hand panel, that these put some pressure on the 10-year yield because of a change in financial positioning. But what about if the 10-year yield really does get above 3? Why might that happen? Well, we might see some inflation coming down. We see a little bit of inflation, a little bit of more labor market tightness. We see some product market tightness, some pressure, some PPI, kind of like it was soft in the issuance today, in the data that came out today. But a 10th here, a 10th there, a 10th on energy, a 10th on other things. These are all upward dimensions to inflation. Let's talk about what might happen next year. You've got another few months of continued pressure. You get some pass-through, a few more tariffs, although the dollar might, appreciation of the dollar might temper that a little bit. But then what happens next year is that the windfall gains to earnings of the tax windfall run out. So next year, firms are faced with a decision. Do they absorb this little bit, 10th here, 10th there, 10th there, into their margins, and they will no longer have the windfall of the tax to protect the margins? Do they pass through those little changes? If we look at NFIB, we know they're itching to pass through. If you look at the PPI guys, they basically are passing through. So the only people who are not passing through in a major way are top-line CPI. So, got to see some potential for nonlinearity there. So let me finish up by talking about what I think is on the docket for the Fed. The picture on the right-hand side, it should be everybody familiar with that, it's the dot plot. And let's focus on 2019, which is the second set of dots from the left. The stars in the dot plot are the financial market pricing of the number of hikes and what the hike is. From March, FOMC in the blue, to the red star is the August FOMC. So the fact that this is next year, this is what the market thinks that the FOMC is going to do next year. And so in contrast to the post-financial crisis period, when the Fed's dot plot came down to the market, what we see the market doing for 2019 is moving towards the dot plot. This is a very important realization by the market that times are different now. And so having some number of rate increases is a belief by the market that the FOMC story about what's going on in the economy is right. There is, of course, a problem in that the median dot, relative to what the market's pricing in, is still about a 50, maybe a 75 basis point gap for next year. What's going to happen? Is the market going to continue to move towards the median dot? What does that do for financial markets? As if you're moving towards the median dot, if the financial markets are moving towards the median dot, it's really hard to do that without some change in the constellation of asset prices that we see today. Narrow spreads and a 10-year below 3. So financial markets are going to adjust. They may not do it in a nice transitional way. And the outcome of the financial market turbulence associated with that move, that closure of the gap in 2019, the real question is, does business change their investment plans in the face of financial market turbulence? That's the question. We're looking at these two groups, the S&P 500, engaged with the financial market, concerned about the global economy, and the NFIB Russell 2000s. And we're trying to tease out, how are they going to think about this turbulence? How does that translate into their sentiment? Are they looking at changing their orders? Because we have data on that. And what happens to outlays, shipments, and spending? And that's the strategy that we have in place to try to evaluate where we are in the global economy and its components for next year. Thank you.
So my name's Michael Drury, and I'm the chief economist of McVane Trading, which is an agricultural commodities trading firm based in Memphis, Tennessee. We specialize in meats, cattle, and hogs. We trade corn, wheat, and soybeans as inputs to the animals, so they're natural hedging opportunities. And we share offices with Arthur Donovan, which is a spin-off from the old Donovan Cotton, which was the premier cotton trading firm in the world before it failed after 2008. So we're about up to our necks in the tariff wars that are going on right now. My job at McVane is that I'm the one person in the office who isn't tied to a computer screen watching it tick minute by minute. And so I'm sent out into the world to travel all around the United States, all around the world. I get to China about 3 times a year, Latin America a couple times, Europe 3 or 4. I'm just back from a trip to Malaysia and Hong Kong, and our basic view of the world is that right now the United States is at the top of its economic cycle. We're looking for 3.5% growth in the second half. It's probably a bit towards the high end of the range, but we think a lot of inventory building is catching up, especially among small businesses, so the NFIB only reinforced my view about that. I'm probably the only person in this room, maybe the only person in the United States, who thinks that the cycle ends before the end of 2019, and that's because I expect the Fed to go in September, again in December, and I expect them to go early in 2019, basically because the U.S. economy remains very strong. A lot of that is premised on the fact that we're in the middle of a tariff war, but I don't think the tariffs bite until the second half of 2019, because we're dealing with the uncertainty part and the expectation part, but the reality, for like in my world, you've seen futures prices change on soybeans, but we don't have a crop. So we don't actually know what soybeans are going to sell for, which will be about 6 weeks from now. So we're still waiting on a lot of the reality, and then the byproduct of the reality, which is if I don't get paid in October or November, what do I do about planting next year? So these are very long cycle issues that the market's very concerned about right now, but will take some time. And so I really think tariffs are a second half of 19 real world as opposed to financial market impact. The flip side of that is that China is at the bottom of its economic cycle. We view China as a 3-year boom-bust cycle going from 3% to 9%. They always report 6%, but that's because the party doesn't want anybody to believe that markets matter more than the party matters. But if you look at their underlying real estate demand, credit flows, electricity use, freight, you'll see that you bottomed in 0, in 03, in 06, in 09, in 12, in 15, and here we are bottoming in 18. We had fully expected this 18 months ago. A number of you here are in NBEC, another group that I'm in, and I made an announcement 18 months ago that China was growing 9%, and one of the top economists in the United States jumped out of his chair and called me an idiot. But that was the peak of their cycle, and they've been going down ever since, and we think they're at the bottom now. We'd expected them to be here, and we'd expected them to be beginning to stimulate. And, when Xi was reappointed, reelected, whatever you want to call that process last November, he did, as we expected, instill a credit crunch on the economy in 2018 to slow it down, to deleverage, in some ways to punish those remaining factions which are not on board with his view of the world. But the expectation was that was the first half of 18, and then they'd start to step off the brake in the second half of 18. The tariffs have caught them pretty much unaware. And, it's been a particular problem for the small businessman in China, and that's a problem. The party mostly focuses on the state-owned enterprises, but when, the small guys are starting to get a little riotous, they don't like that. I tell people the party wakes up every day and asks itself one and only one question, which is, what do I need to do to be in charge at the end of the day? And if that takes reform, they reform, and if that takes repression, they repress. And where they are right now is they're getting a little nervous about the fact that the natives are not happy with the outlook for the economy. There was just a big conference in China that's called the Beidai Conference, where all of the top rulers, old and new, get together, and there was some fairly open, vocal criticism of Xi at that meeting. We don't think that that's changing the tone, but it just indicates that there is this underlying concern in China. It's not so much in the core of the party, which is pretty much under Xi's control, but the mandarins are not very happy right now. The next tier down are not very happy, maybe not unlike in the United States. But having just been in Malaysia and in China, I got to say, coming back, that growth is weaker than I had expected it to be. And I was already at 4 to 5%, so now I'm down to maybe 3%. And the reason for that, again, is a combination of this credit crunch, but the tariffs, because the tariffs are really disrupting the little guy who's in the supply chain. Exports have been falling now for the last 4 months, and it's exports falling because imports coming in from Taiwan and Korea and Japan are falling as well, because everyone's just kind of putting on the brakes, caution. They're not sure what's going to happen, and they don't want to be fully exposed. So the small guy doesn't get the subsidies from the government that the bigger guy gets, and so a lot of them are both hit by the credit crunch and then by the fact that their cash flow is slowing down. Chinese small businesses tend to be very highly levered. The individuals who own them have very high wealth levels. They save a lot, but they don't put it in their business. They borrow the money to run their business because they can operate with larger scale and with more leveraged margins to earn higher returns on the firms. And they've always been able to roll over their debt, every quarter, every year end, whatever, maybe at higher or lower rates, but they've always been able to roll it over. The difference in 2018 is that credit just isn't available to a lot of them. And that's caused a minor panic where we're hearing, before I went over, I heard that real estate was being sold in Vancouver because basically you're in a sell what you can sell phenomenon where the stock market's down 20, 25%, depending on how you count and which market you're looking at in China. The real estate market's soft, and particularly soft in the big cities where these businessmen would like to sell. There's no buyers because they're the ones who would be the buyers and they're not buying. And so they're selling what they can sell. And when I was in Malaysia, I heard that there's selling going on in Johor Bahru, which is the city just across the border from Singapore. That's a particularly interesting market because Country Gardens, which was a big Chinese real estate developer, built about 100,000 basically empty homes in Johor Bahru. And the reason was that you could pay for them in yuan, renminbi, in China. So it was a way to move $1 million out of China without ever having to leave China. And now the government's basically shut that one down, and people now trying to get their money out are having to sell down 20, 25% to get their money back out. And there was never any appreciation, so it's not a story of, oh, it went up and I'm selling a winner. It's a dead loss. We're hearing the same thing in Hong Kong. We're hearing that the mainlanders have stopped buying in Hong Kong and they're starting to sell. This is partly HIBOR going up, so it's gotten more expensive, but a lot of those properties are owned cash only, and so it's not really a carrying cost issue. Again, it's I need the money back home. And so I view the fact that I'm hearing that story not from one source, but from many sources as telling me it's true, and then I get, people in China telling me the small businesses are strapped and that's a problem. So here we are with the United States at the top, China at the bottom. China is starting to stimulate. They just announced about a month ago a $199 billion infrastructure project. That's a little over 1.5% of GDP in China. That's kind of the thing you would do if you were at the bottom of a cycle. They just announced last week a $7 billion tax cut for the, kind of the middle class, the guy who earns about $30,000-$40,000 a year, which is, that's really upper class, but that's the small businessman in China, and it's basically to allow him to finance. But we're also hearing that the number of students leaving China is down between 20 and 25%. Now, I'd heard this in the United States about their attendance at U.S. universities, but that had more to do with the fact that they couldn't get visas to stay here. And at that time, we were hearing that they were moving to the UK, New Zealand, Canada, Australia. What I was hearing on this trip is that they're just not being sent, and it's basically because they can't afford the $50,000 to $100,000 that it costs to send a student offshore for a year. That there is really a credit crunch going on in China. So what do I expect to happen? I expect the Chinese to step on the gas. And the reason I expect that is that 2020 is a particularly important year for the Chinese. It's the 100th anniversary of the party. And they're going to have a party for the party. And the job at the party for the party is to show the world that capitalism or socialism with Chinese characteristics works and works better than anything else that an emerging market could currently adopt. Better than capitalism, better than Russian communism, better than anything, and that it's the model that you should use. That's a significant purpose of One Belt, One Road, is to take their success, take the show on the road, and show the rest of the world how they can do the same thing that China did. It's also a nice way to get rid of excess capacity in the capital spending sector and buy influence around the world, but these are all together. Then the other big program in China, the China 2025, that's about moving up the scale because they know that they're going to lose the industries underneath. Textiles, toys, plastics are already moving offshore. The Chinese aren't that worried about that because as long as it's moving to Vietnam, Malaysia, Indonesia, Thailand, as those economies rise, China's going to be the major beneficiary, much the way that New York is the major beneficiary when jobs move from Detroit to North or South Carolina, because the financing, the branding, the marketing is still all New York City. So this is our model of the world, and this is our concern. So now the big question is, what wrench does tariffs and trade throw into this? Well, when the tariff war started, when Trump first started the tariff war, this came after his massive stimulus of tax cuts and then spending hikes. So basically, from an American point of view, he felt like he could pull back some of the goodie that he had just put out there, and that he could ask for better trade terms. He could ask multinationals to help him bring trade back into line. And when he started, it was a matter of, well, China buys, 150 from us and we buy 500 from them, and that's not fair. And the same is true of Canada, and the same is true of Mexico, and the same is true of Japan, and the same is true of Europe, specifically Germany, and this is why the cannon are fired in all directions. China's obviously the big kahuna because it's the biggest number, but that's where you started. And that's why the first tariffs were on washing machines and solar, and then it went to steel and aluminum. Mostly, even the steel and aluminum, people say, well, it's not all manufactured in China. Yeah, it is. All the marginal stuff is manufactured in China, and that's why that was the focus. And it's a big deal. The price there is a big deal in China. Those tariffs, they don't amount to enough money to care about. But then things started to morph, because that's when the lobbyists started going to Trump and saying, we don't care about the trade gap. In fact, we like the trade gap. The trade gap is us. It's us making money. What we're concerned about is access to Chinese markets. We want to go into China and do even more business and make even more money and run an even bigger trade deficit with China by manufacturing goods there to either sell outside of China, maybe to bring back to the United States, but increasingly to build in China and sell in China and bring the returns home. That's what we're worried about. And we can't get good rules to do business in China, and they have great rules to do business in the United States. And they're increasingly competing with us to buy firms in the United States, Shuangwei buying Smithfield in my industry, and we're having a hard time participating in China. They say they're opening up, but it's happening too slow. And so it started to morph that way. And that's why when Ross went and came back with a deal that basically said the Chinese will buy $200 billion more in 2 years, the Chinese thought they had a deal. And Trump said, no, that's not a good deal. So then they sent Mnuchin, and Mnuchin came back with a deal that basically said the same thing, the $200 billion, but he was also going to get some opening up of automobiles and financial services and movies, because he's a movie guy, and a few other things like that. And he came back, and Trump said, no, that's not the deal either. And the Chinese, they don't like this. They're not very comfortable with deals not being deals. And so they have a very high bar of distrust now. There's a meeting that's just been called for September 16th. It's called by Wang Xishan, who is the vice president of China and is Xi's closest advisor. He's long been known as the fireman of China for putting out fires, the crisis in Guangdong province, the rebuilding of Shanghai, the rebuilding of Beijing. And people have been waiting for him to be brought into the fray. And now he's been brought in. He talked to Hank Paulson. He asked him to bring representatives from the 5 biggest financial institutions in the United States, who the Chinese think basically run the government in the United States, because that's the way it works in China. So it's basically Blackstone, Citi, JP, Morgan Stanley, and I'm missing somebody, Goldman. We've been asked to come. So far, we hear 4 of them are sending representatives. And on the Chinese side, it's Zhou Xiaoxuan, who's the old central banker, Wang Yi, who's the new central banker, a deputy minister from finance, their bank and insurance regulatory guy. In other words, all of the top government finance guys on this side versus all of the top U.S. private sector guys on this side. The question is this just a meeting to find out what is going on? Or is this a meeting to discuss the opening up of the financial services industry, which they might throw a bone, as we move? We don't expect anything from China before the midterms, because it's 60 days. They can wait 60 days. In fact, the Chinese have indicated they can wait 2 years for the re-election. They're a very patient society. They will wait out as long as they can, as long as it's not a crisis for them. And the real collision of thought here is that to America, China is dependent on exports to the United States. To China, exports to the United States represent 15% of their exports, which represents somewhere between 1 and 1.5% of their GDP. And so they're not happy with a trade war with the United States, but they feel that they could deal with it, and they estimate 0.5% off of GDP. So say they're wrong and it's 1.5 or 2. If they're growing 6, then that's a problem, but it's not a crisis. It's something they can deal with. And how are they dealing with it? They announced a week ago, maybe it was this weekend, I can't even keep track, that they would double their aid to Africa from $30 billion to $60 billion. A month ago, they purchased a lease on 1 million hectare, that's Rhode Island plus Delaware, for agricultural production in Russia. They leased the land. That's not very good land. They just cut a deal with Ethiopia where they reduced their debt and they would take soybeans as payment. Now, all of these are minuscule numbers coming back versus the $15 billion in soybeans that they buy from the United States. But the point is, they are preparing for a world, not this year, not next year, but 5 years down the road when they won't buy any agricultural products from the United States because they view the United States as an unreliable provider. And if you've got an unreliable provider, I don't care what business you're in. My dad used to be a chemical engineer for W.R. Grace, and it used to tick him off because every time he came out with a new product, the first thing his client would do is run down the street and show it to Dow, Monsanto, so that they weren't stuck with a single provider. And that's what China's doing, is they're looking around the world for alternative providers of everything that they currently buy from the United States and preparing for a world in which they may not be the direct provider of all these goods to the United States. But they expect it to go into Vietnam, into Indonesia, into Malaysia, probably in Chinese-run plants. I said we shared offices with Donovan Cotton. The largest cotton milling operation on the planet is currently in Vietnam. It's Chinese-owned. And so, those are the kinds of things that you're increasingly seeing happen, is the Chinese buying offshore in Asia. And so that's where we think this morphs to. Increasingly, the Chinese are saying there'll be a world in which the United States has Canada and Mexico, really good for Mexico, and we have everything else. And One Belt, One Road connects Asia to Europe. We own Africa. We can deal with that world. Nobody believes that in the United States. I go around the world and I tell people this all the time. Nobody believes that story. But that's the story as they believe it in China. They could be dead wrong. But Xi is not about to change his mind on things, and he's not up for re-election, and he doesn't face any midterms or any other kind of pressure. So it's going to take a lot more pressure, a much weaker economy, more instability in the streets before he's going to blink. And he's hoping that the midterm elections force Trump to blink. So that's kind of where we are in the process right now. And we're going to wait the 60 days and see what happens in the midterm and see if that changes things. The Chinese biggest concern right now, and this is kind of new, this is within 30 days, is that in order to control Trump, they've been going around the world talking to the Koreans, to the Japanese, to the EU, looking for friends to fight the U.S. America First trade war. And the bottom line is they haven't found any friends. They haven't found much help from the EU. They've gotten no help at all from the Koreans or the Japanese. And they're beginning to worry that it's working the other way around, that the United States is going to be able to ally with Mexico and Canada, then settle with the EU, and then they'll all gang up on China. And so China's increasingly worried that it's in this world where they're the odd man out on trade, and they're going to have to deal with much more difficult trade situation. And that's why you're seeing this tamping down of the kind of blatant nationalism in China, and you're seeing them going around talking to people now. And that's why, frankly, the Africa thing is to buy the one remaining friend that they seem to have out there. But I don't have a solution. I don't have where I really think this is going to go. These are the forces that we're watching. And the first one is 60 days from now, what happens in the election. And then the consequences of that, because in the United States, Trump is still where Trump is, and there's no reason for him to move because he doesn't think he's going to lose. And the stock market's up, the economy's fine, NFIB tells him he's a genius. The Rasmussen poll is the only one that hasn't faded. It's the only one that he looks at. He's not going to give up. The Republican Party seems to be moving in his direction. One of the things the Chinese are worried about is the Democratic Party seems to be moving in his direction because they're as pro-U.S. production, U.S. domestic union as Trump is. And now the rest of the world seems to be moving against them as well. So they're feeling a lot more pressure than they were a year ago. To me, that suggests that there'll be a lot more domestic stimulus in China, and that means that they'll go back to using debt as the stimulus sometime late this year, early next year. People ask me, how is that possible with their debt to GDP the level it is? To which I respond, well, what is GDP in China? Can you really give me a number within a couple trillion? And the answer is no, you can't. And if you can't measure GDP within a trillion, can you really measure debt within a trillion? I don't think anybody, including the party, knows how much debt there is in China. We're seeing this in the credit crunch. HNA is selling everything that they own offshore. Anbang had to do this before. Others have had to do this before. And as they sell it, they give up their equity position in order to repay debt. And who ends up buying it? Well, the guy who used to lend them the money. So the debt's disappeared, but the ownership is in the same place that it was before. And this is the problem with debt in China, is there's layers and layers and layers of debt, where I borrowed the money from Catherine borrowed it from Philip borrowed it from Sangeetha, and you don't know if you're counting the same debt 2 or 3 times. What we do know is that interest rates in China for government money is 5% in an economy which grows 10% nominal. That seems to me like the interest rate's too low. In the United States, we think that 275, 290 now on a 10-year note is too low because we got, 2% potential and 2% inflation, should be 4. In Europe, we know it's too low because they're at, near zero, and their potential is maybe 1, and even with no inflation, their nominal's 2. So basic Wixellian tells you that, if your nominal risk-free interest rate is below your nominal growth, interest rates aren't a problem yet. And if you're at 5, you can go to 2, you can go to 1, you can go to 0. Others have been there. So I don't think the amount of debt relative to GDP is ever going to be a barrier in the 2-year horizon that I need to look at in my crystal ball. That's my story, and I'm sticking to it. Thank you.
Thanks, Michael. And we have Phil Levy to speak now.
All right, thank you. I'll try to be brief so we have some time to discuss. And also because we've just had excellent presentations on sort of the macroeconomic situation, I think what I will try to focus on is the trade wars. The things that are sort of at the heart of this, in particular 3 conflicts, what has happened with them so far, and what are the prospects for resolution, if any? Where do we think this might go? And then draw out some themes if I can. So the 3 conflicts I want to talk about are, I will classify them as Section 232, the national security tariffs. This has so far been steel and aluminum. The conflict with China, where I'll be brief because I think that was well covered just now. And then what's going on with NAFTA and what possible resolution there is for that. I'll start with the Section 232 because that's global. It's been sort of applied more broadly. I call it Section 232 because that's what trade geeks do. We sort of find which section of obscure trade law allows you to do these things. And this is what the administration did. The president said he wanted to apply tariffs. He was told, well, that's kind of set by Congress. And, we have a few little ways you can do this. There's anti-dumping. There's countervailing duties that are sort of legit, but those are very established procedures. So you can't just go slapping tariffs on something because you want to. That was unsatisfactory. Lawyers sent scrambling. You dust off the old tomes and you find in, the Trade Expansion Act of 1962, Section 232, it says, oh, hey, look, if the president decides that it's in the national security interest, he can, take actions against trade. The president says, okay, it's in the national security interest. Actually, it wasn't quite that fast. There was a long study done by the Commerce Department. This was supposed to be due in mid-2017. It sort of lingered. It didn't come out. People thought, maybe they're not serious about this. I think, in fact, it was just waiting to have for 2 things. It was waiting for the tax cuts to pass, and it was waiting for the president to kind of get fed up with the adult minders, as they were somewhat known, like people like Gary Cohn, who were more market-oriented. We saw that in about March of this year. That was, the report had emerged earlier than that. It had the Commerce Department saying, yes, there's a national security interest in protecting aluminum and steel. Not because there's any particular crisis going in. In fact, the data they showed that there was not actually a crisis. Not because there was any particular link to conventional national security concerns. In fact, the Department of Defense said, we don't see it. We don't think there is anything here. It was blatantly premised upon economic security is national security. So whatever is good for these sectors, we are defining that as national security. Okay, so this was not, do you have enough steel to build tanks or enough aluminum for whatever weapons you might make out of aluminum? I have no idea. Aircraft, perhaps. It very loosely and dangerously played on ostensibly a loophole in the World Trade Organization. It's something called Article 21 of the GATT, which was sometimes taken to say if you need to do something for national security, that's okay, we release you from your earlier obligations. In fact, that's not what Article 21 says. Article 21, the founders were not quite that dense who did this. It gives some specifics. It says, we're imagining really three scenarios. Trading in fissionable material, trading in implements of war, trading in time of war. But we don't have any of those. None of that's going on. So this is a problem. I'll come back to this in terms of sort of thinking of the resolution of this. In any case, it had a sort of very unusual rollout. It was sort of a non-rollout rollout. The White House denied there would be any announcement in the morning, and so then you had the announcement in the morning. And the president said, I'm going to put tariffs on everybody, 25% on steel, 10% on aluminum. 2 weeks later, this was clarified to, I mean only 1/3 of our steel supply, and everybody else gets an exemption, but it's a temporary exemption. For how long, we don't know. Stay tuned. You get to, so that's mid-March when you are getting this. And so countries like Japan did get hit, Korea did get hit. So it wasn't that there was nothing that happened, but it was fairly limited in its application. On the other hand, broad swaths of our trading partners had been exempted. So if Canada and Mexico, Europe. By the way, I would sort of note, this is not the same as what we had seen under the Obama administration or under the Bush administration. That those, yes, there were tariffs, there's tariffs throughout, things like anti-dumping and countervailing duties. It's how much is this sort of conventional measures where everybody says, we understand the rules of the game. The Bush administration in steel did a safeguard action. Ultimately, the WTO said you didn't do it right. They said, okay, we take it back. The Obama administration did things like a China 421 safeguard, but again, fairly well-established rules. Maybe unwise, I would argue they were, but fairly well-established. This is really touching on taboo subjects, and I'll say why in a second, because it gets to the WTO thing. So a breach, but it seemed limited to start with. You get to the end of April, when these temporary exclusions for countries were supposed to expire, really got to the very last day of April. White House still says we don't know what's going on. They roll them over. And it says, aha, we understand the game. You roll these things over, and so for the most part, this is for show. You get to the end of May, everybody says, we got it, you're going to roll it over. No, not rolling over. All of a sudden, you're going to have steel and aluminum tariffs on Canada, Mexico, Europe, and all the others. This is a surprise. The reason I give you that play-by-play is partly to note, I would sort of mark June 1st as a bit of the kickoff when we really started doing this. So if you want to sort of think, how bad are the effects? What are we getting to? I would note, it's starting fairly recently, and it was a bit of a surprise. This was not something that was sort of long anticipated. So to the extent we're sort of, as Catherine was talking about with sort of expectations and investment, you're building that in, this is a challenging environment in which to form accurate expectations. So, what has happened with this, and where does this lead in particular? A couple things on this. It was telling, two telling bits of evidence, and then one forecast. The telling bits of evidence, at one point, USTR Lighthizer was called in front of a congressional panel, and kind of mocked a little bit, sort of, is Canada really a national security threat? He went with the premise of what they're saying, which is, well, yes, if you're going to say economic security is national security, if we are going to allow, say, a country to get a pass from this, if you let the Canadians provide aluminum or the Canadians provide steel, then you don't get the effects you were looking for the domestic steel industry. A thoroughly protectionist argument, but so therefore, if you're going to do the economic security equals national security, then yeah, they are. In other words, if you really want to accomplish the objective, this is not addressing sort of conventional national security concerns partner by partner. The comprehensiveness of it is essential to what they're trying to accomplish. A second piece of evidence along those lines is where we have seen the administration work things out with other countries. Working out has tended to mean the protection becomes permanent. So the prime example we have of this is Korea. So in the context of renegotiating the U.S.-Korea free trade agreement, they talked about the steel tariffs. What emerged from that? That Korea accepted a quota a voluntary export restraint, for those who indulge in such things, of 70% of the past 3 years' average shipments of steel. And part of this hasn't quite come to pass yet, partly because of future concerns, but also because, as the Koreans had discovered, it was also sort of the most binding possible interpretations of the quota at every turn. That it was a quota not starting in May, but starting in January, which meant that most of their industries had already met the quota, or many had met the quota. It was no allowance for sort of movement between categories. So wherever you could put on a sort of tight interpretation, and then also no exemptions for people who are trading with Korea. So again, the solution was more protection. All right, so so where does the 232 stuff lead? The concern is it leads towards cars. That it leads to automobiles. And we know this. This is the fun thing about this administration. They tell you what's going to happen. You just have to listen and believe it. And that last part can be hard. But they will tell you. They'll say, we're going to do cars. And the trick is, I think they see the steel and aluminum experience as proof of concept. That you did it, you came up with a laughable justification. Everybody said you're going to get killed on that justification, markets are going to crash, your political support's going to plummet. None of that happened. They got away with the justification, markets didn't crash, political support stayed pretty much constant. All right, now let's go big. And autos are going big. That autos trade is substantially bigger than steel and aluminum trade. My numbers-oriented friends can correct me, but I think we're talking about 8 to 9 times as big in terms of trade flows if you go after autos. So that's what's dominating people's concern, is that this is coming up. The president said he wants to do this. He thinks it's a political winner, and all indications have been, because he thinks it's a political winner, you do this before the midterms, because you want to get this out there, because all the automakers and the auto workers will be so happy. That's me paraphrasing a tweet. The automakers and even the workers have said, not so much. But in any case, that's where this seems to be heading. I will be very light on the China stuff in the interest of time. The point that I would sort of repeat and stress is, by my count, if you're looking at this from a Chinese perspective, you struck 4 deals with the U.S. There was the 100-day deal that came out of the Florida meeting there, which sort of went through, but then the U.S. and the administration trumpeted as great, but then moved on. There was a summer deal on steel capacity with Wilbur Ross in 2017, which then was rejected, as you said, by the president. There was President Trump going to Beijing in November, where there was a whole series of deals that then didn't seem to resolve anything. And then there was all of the dealing with Treasury Secretary Mnuchin and with the visit by Liu He, who, from the Chinese perspective, personal emissary of Xi Jinping. This was essentially a leaders' summit. You get a deal, he comes back, and then you're told no. It's easy to understand why, from the Chinese perspective. So one thing, you don't know if you're talking to the right person. So how do you even have such conversations? Because if you keep talking to Wilbur Ross and he doesn't represent the thinking of the president, then what good is it to talk to Wilbur Ross? And if you talk to Steve Mnuchin, who's put forward, and he doesn't represent the thinking of the president, what good is it to talk to Steve Mnuchin? So are you talking to the right guy? And what we saw then was, in August, when the Chinese sent a delegation, it was a much lower ranking delegation. It was sort of pro forma, vice ministerial. All right, we'll talk. So you've got the problem of whom to talk to. Do they actually represent the president? And are there actually any meetable demands that suffice? Or is this going to be like, say, the Beijing meeting and the 100-day deal, where you do a bunch of stuff and then 1 month later, all right, let's go at it again. In which case you haven't bought yourself anything. It's a never-ending struggle. So I think sort of China, we're in for the long haul, and we're seeing an escalation on this. The last of the conflicts I want to take up is NAFTA. NAFTA, this is not unrelated to the Section 232, because the president, I think the administration is under a fair bit of pressure to show that it can actually do something in its trade approach. Remember, this is the president who came in and said these deals are easy, it's easy to get a better deal, and so far we haven't had any deals that have been seen through to fruition. We saw at the end of August what was announced as a deal. It was more of a phone call, but with Mexico, this was problematic since it excluded Canada, and because Canada didn't even sign on later that week, where the hurdle was very, very low in terms of what was needed to sort of say, okay, we agree to agree, we've got 30 days, we'll work stuff out. We are now almost midway through September. They still haven't worked this out. They're under a deadline. It's a bit of an odd deadline. It's a deadline that is a combination of U.S. trade law and Mexican politics. So the Mexican politics part says they're going to change from Enrique Peña Nieto to Andrés Manuel López Obrador on December 1st. Okay, for political reasons, it's difficult while López Obrador has been supportive of the negotiations, has been monitoring the negotiations, it would be difficult for him to sign things without some more serious changes. So they say, we want to get this done by December 1st. U.S. trade law says if you want to do that, you need to give Congress 90 days notice before you sign something. That's what the end of August deadline was. And then you need to give 60 days notice before you, 60 days of actual text. The whole agreement has to be written out. And there it is, Congress can analyze this. Note, by the way, you might say, easy enough, I'll just sort of tell them I have an agreement, I don't really. There is a problem with that, which is, by the end of this month, you've got a whole slew of advisory groups who are supposed to issue reports on what this deal does. That's difficult when you don't actually have a deal. And that's the position they're in. And Congress has noticed. So you actually just had a statement yesterday from Democrats on the Ways and Means Committee saying, you're doing this all wrong. So first, these notification requirements, you told us you were doing a trilateral deal. You seem to be doing a bilateral deal. You never notified us about a bilateral deal. Second, what's going on with with these advisory groups? And are you not consulting? What does this all mean? It means there's a lot of pressure on the administration. It's very hard to see how this works out well. It's almost certainly going, if it does work out well, it almost certainly goes in front of the next Congress. We don't know who leads the next Congress. There's some indications that Democrats may be in control of at least the House. And the administration has not really done its homework in terms of making sure things are okay with them. It's made a couple of moves in their direction. So you're seeing the introduction of things like labor requirements in a more enforceable central way in trade agreements. That's long been anathema to congressional Republicans. So that's a gamble. Are you going to pick up Democrats in sufficient numbers to replace Republicans? Or will Republicans just do this anyways because they want to be supportive of President Trump? There's enormous hurdles on that front. The other hurdle that I will note is come back to things like cars and steel and aluminum. The Mexicans and the Canadians are thinking, all right, even if we go along with all of this, that does mean we're exempt from all that stuff, right? This is where they thought they were to start with, because, for example, President Bush had exempted them from the steel tariffs in 2001 because it was NAFTA. So they're thinking, well, of course, but it's not clear that the administration wants to do that. No one has been exempt. No one has been given a pass, even after negotiations. Let me just conclude with some sort of themes that we take out of all of this, the new art of the deal. The general approach has been, as you look at this, to make it almost impossible for the other side to do what you want them to do. You saw that we've seen this sort of with China, that there's been a big frontal attack, loss of face, other things, making it extremely difficult, even if the Chinese want to give in. There's no way for them to give in, and is becoming sort of politically very damaging. We saw the president in the end of August, just as he was sort of really critically needing to have the Canadians get on board, he leaks out, it appears, that I'm making no concessions to the Canadians, and I paraphrase, the only way this is going to get done is if they come groveling to me. Surprise, surprise, with Canadian elections coming, they didn't go for that one as a sales pitch. So this is a persistent problem. I would note another theme, whatever you end up proposing, it's not liberalization. So this is what we've seen on the 232s, as I discussed. It's true with what we've seen on NAFTA as well. The stories that have come out about NAFTA, this is not how to open markets. This is how to be more restrictive in the auto sector, or other things. So this is not a different, better push towards liberalization. It's a push away from liberalization. Third point I would sort of note on this, there's been essentially no effective work with Congress to sort of lay the groundwork for things. And under the Constitution, it's Congress that sets trade policy. And in the long run, they do. They like to sit on their hands. They shy away from difficult challenges. But ultimately, for things like trade agreements, you do need Congress on board. Instead, we've seen a sort of lack of communication, lack of cooperation at each stage, and very vocal complaints from both sides of the aisle. From, if you look at, say, the Ways and Means Committee and the Senate Finance Committee, you have had Chairman Hatch, Chairman Brady, Minority Leader, Pascrell, or Ranking Member Pascrell. They've each been Ron Wyden. They've all been coming out saying this is unsatisfactory. This doesn't work. This is bad. So that is a bit of a time bomb that we're waiting for. And then the last thing I would note is really no ability to play well with others. So there is this sort of scenario that Michael described of, is China the main concern? Do we team up? You've had some initial discussions, but there's no ability to sort of help themselves and downplay some conflicts to sort of have collaboration with others. Plus, you mix that with a very strong preference for bilateral approaches, which seems to essentially preclude that kind of sort of multilateral cooperation, even when it would provide a great deal of leverage. So let me stop there.
Thank you for some great remarks. I'm going to just, as moderator, just ask the first question. So we've talked today a fair amount about how the asymmetric risk to the global outlook is largely focused on U.S. and China, and notably on trade tensions. Who do you think potentially gets caught in the crosshairs, i.e., how does emerging markets, how does that part of the world do, and what is your outlook for how they will affect the global outlook? And I'll start with Catherine.
Well, I think what I was talking about in the context of both the slowdown in China as well as the trade conflicts, that there is no such thing as a bilateral trade war. I mean, the U.S. thinks it's in a trade war with just China, but because of the depth of the global value chains, the collateral damage to the rest of the emerging markets is really large. And we can quantify this, and we've done so not just to individual markets, but across different product categories. So the team in my Hong Kong team has looked at a decomposition on a value chain basis of 6,000 different products. So if you want to know which product is in which country, which is going to get whacked the most, we can give it to you. And so the collateral damage to the emerging markets is, we see it in production. We've also seen it in terms of capital flows. It's not just, Turkey and Argentina have their problems, obviously, but, in terms of the actual contagion effect, the contagion effect is generated by the trade side as much as by capital flows being contagioned via the Turkey and Argentina situation. So the emerging markets get to look at the prospects for stagflation, big time. Got a depreciation of their currencies and or a tightening of their policy rates. So you either get inflation or you get lower growth, plus you add on top of that lower growth through the implications for the global value chain. You might say, oh, well, the U.S. is going to grow a lot, buy a lot of imports, and so that's going to work. Well, I think we've just heard that that's probably not the direction that we're going to go, that the U.S. is a locomotive, that it's unhitching itself from the global economy. So it's going to go up the hill at whatever pace, and all the cars are gonna go down the hill. So there's nothing good that comes out of this. I mean, yes, you can like pick a little bit here and there. Oh well, German cars might do better if cars become the next salvo, but net, it's negative.
Thanks.
So we For the commodities world, the number that I follow most closely is dollar-denominated growth in Chinese GDP, because that's the buying power of the world's largest consumer in dollars, which is what all commodities are priced in. And since the start of the year, you had a big ramping up of the renminbi at the end of 2017, and then they gave it all back. So basically, there's been no growth in the renminbi, and, if you look at my numbers where you think that GDP is only growing someplace in the 3 to 4% range, then you're at a pretty punkish level of nominal GDP growth in dollars. Not quite as bad as 15, but almost that bad. And then throw on top of that you borrowed your money in dollars and that the Fed's tightening. And it's about the worst environment that an emerging market that's a commodities seller, if you're like India and you're a commodity buyer, maybe it's a little different, but it's about the worst market that you can get. And what that does is it backs up, because now their buying power is hit by the fact that the currencies are down anywhere from 15 to 20%, depending on who you're looking at. That backs up because they can't buy capital goods from the people that they would normally buy them from, and that's Japan, Korea, Germany, Sweden, etc. So the only guy who's winning here is the U.S., and the question is for how long, because everybody else is already fading.
So I would just say there's serious concern with emerging markets. Part of the pattern, I didn't quite finish with the whole WTO thing, where we undermine institutions. That's the reason people didn't do the Article 21 stuff, is because the U.S. has said that's self-judging, and therefore all you do is say national security, you can do anything. That pulls the institution apart, because anybody can pull that trick. So let me move from that back to the actual question on pulling things apart. The U.S. has traditionally tried to stabilize the global economy and to sort of restore confidence. What we've seen in places like Turkey and Pakistan is exactly the opposite. That when you get a fragile situation, if you see somebody teetering, give them a kick, see what happens. So that was what happened with Turkey. Turkey was having, in each of these cases, there are serious problems, don't get me wrong. The Turkey was having lots of trouble. The U.S. says, you know what, we're doing double steel tariffs on you. Oh, that'll help. With Pakistan, we're not going to support any IMF stuff because it's effectively bailing out China. So this is the old, to do a different metaphor, you've got a fuel spill, people can help come on the cleanup, or you can light a cigarette. And we seem to be lighting a cigarette. Things have not actually caught yet. That's good, but it's not for lack of trying on our part.
Great. I'm going to open this up to the audience. If anyone has any questions, just raise your hand. Steve.
So a follow-up on Paul's point about Congress making. Typically, there's some higher order legal authority. Is there any mechanism, practical or real, for Congress to rein in interpretations of our trade laws? Or is it really effectively true that and set trade law and had that much
So the good question. The national security loophole is a real one, because Congress did write this into the Trade Expansion Act of 1962.
Kennedy, right? Yeah.
Yeah. So and courts have previously found that's okay. There's some court challenges based on you had to give some sort of plausible thing. You've had moves in Congress, a bill introduced by Senator Corker in the Senate, Mike Gallagher in the House, to try and say Congress can take this power back. They could if they could get their act together. The problem is that would almost certainly be vetoed. The president has said he doesn't like such moves. They've lobbied against them. So then you need about 2/3 to override that. So a very high hurdle for Congress to act on these things. And so far they've shown no ability. They can barely pass resolutions of disapproval. However, I would say when you're talking about something like, can you get the new version of NAFTA through? Now you kind of flip the burden on who has to do things, because it's a lot easier to be inactive in Congress than it is to get a consensus generated and get stuff passed in both houses. On the NAFTA stuff, they actually have to pass this if this is going to go anywhere. And so it's very easy then to say, it's got a few good things, but, on balance, I don't like it. I don't think it's good for American workers or American farmers. Okay, then you don't have it. So Congress does retain power on this, hard when they have to be, active, but you have this other possibility.
So just a qualification. So if I take a liberal interpretation, I can do anything because it's economic security, economic security, national security. There's no court to go to strike that down. If I'm an individual citizen, if I'm a congressman.
Some have tried on some of these things. So there's an effort on that to say, yeah, at least had to kind of show the national security tie. I'm not a lawyer, most of the lawyers I've talked to don't think that's very likely to succeed. There is a court move that's been filed against the next tranche of China tariffs. The argument there was that under Section 301, when you filed this, you needed to sort of show, here was the damage and I am responding proportionately to the damage. The damage they found was 50 billion. They responded 50 billion. So how do you get another 200 billion out of that? It was not supposed to be carte blanche to just then go as many tariffs as you want. There is a court case. We will see whether courts are likely to intervene. I think if you saw something like the president trying to withdraw from NAFTA, which he might do to try to force Congress's hand, and because he's said 100 times that he wants to, there would certainly be court cases that would come out of that, because there's very sharp disputes, and I've heard good arguments on both sides of this, whether the president actually has that power to withdraw from NAFTA and to end an agreement. So that would almost certainly get set to courts. I imagine it would end up looking a lot like things like the immigrant travel ban, where you get a district court in one place. You'd have lots of farmers, for example, with standing saying, look, I'm getting hurt by this. Some federal district judge says, all right, I'm putting a stay on this, so we'll talk it out. You would have a legal morass. If you want to get back to, do we have uncertainty that's blocking investment? Now you're going to have uncertainty in abundance.
Can I just ask one more question from the audience, if anyone has anything? Yeah, please.
Hi. As a fellow trade nerd, on the renewed Section 203, obviously Ross is still waiting to publish his findings on the car tariffs. Your premise was that could happen before the midterms. Ross has come out and said that he's staying released through August into September, pending European talks, pending NAFTA. NAFTA may be resolved possibly trilaterally today. Gallardo said that the draft text was trilateral in character. So we're now looking, say that works out, we're looking at the European scenario. Lighthizer came back from his discussions with Milstrom, positive. The whole timeline for the midterms, for Ross to release, for Trump to take action, is getting incredibly short. Do you think that it is likely that immediately after September 28, which is the last Friday, so that Monday, October 1st, Ross will move? Do you think that because that's sort of the timeline you're looking at in order to have any impact on a November 8 election, right? So
I think you could do it anytime in October and say, hey, look at the great things we're doing, if you think this is a plus. I would, with all due respect, say you're engaging in old school thinking. Old school thinking, like where you have to have a plan and you have to roll it out and it takes a lot of preparation and you do these things. You need to get with the times, which is you can announce something overnight, and then when reporters ask, well, will that apply here? And what about that? And you just leave that for your aides to try to figure out. And so, you're right. They're sort of doing a lot of balls in the air and going in many different directions. I would note that whenever they've landed these things, they've landed them with more protection. I think the trick that you have at the moment is the president likes the idea of doing trade deals. He just doesn't like the idea of trade. And sometimes those go together, and you're actually supposed to liberalize with these things. I think that's where you're seeing, and they haven't yet shown any instance where this gets resolved in a more liberal or any kind of liberal way, because I don't think that's what the president wants to do. So if I had to bet on it, I'd still bet that we're going to see auto stuff. And I think the Europeans took a lot of solace in that promise, that sort of late July meeting, and, oh, look, we got a truce. I don't know why. I mean, because Canada and Mexico had a truce on steel and aluminum, while NAFTA negotiations were ongoing. That lasted right up until it didn't last anymore. Because as of June 1st, the negotiations were still ongoing. That had been the original premise, and yet all of a sudden they weren't exempt anymore. because it was no longer convenient.
Some more fireworks before the midterms. Thanks, everybody.